Okay, good evening. Thanks everyone. Tonight it's Sunday. It's our usual Chinese coffee cup and Viswise Academy's financial talk time. Tonight we are honored to invite Jamie, a professor from Columbia and Baruch, and also he has his own company focused on cryptocurrency. And I think let Jamie to give yourself a very good self-introduction. And I think you can tell more than me.
Yeah, sure. Like you said, yeah, I do. I run a company called Chain House. I have it in my slide deck a little bit about me. And I'll go into that once I start the presentation.
Okay. Yep. So I make you a co-host, and you can share your screen.
Can you see the screen?
Yes, we can see.
Okay, great.
Everything looks good. So let's start.
Okay, we can start?
Yeah.
Okay, great. Welcome everyone to this introduction to cryptocurrency and DeFi. I want to thank the management team of the Coffee Club, yeah, including Angeline and her team that help put this together. Thank you for including me and giving me the opportunity to do this talk. So what I'm going to cover today is some basics around cryptocurrency and introduce you guys to DeFi. What is DeFi? And hopefully you'll get some of the basics. And I'll leave some room, some time for some questions at the end. I have about 100 slides. I'm going to try to go through them fairly quickly. Obviously, if you have any questions, please feel to ask. You know, some of this material may be new and complex, but I think this is a great way to get introduction to DeFi and to kind of see where the power is in terms of potentially making money in the future with using DeFi. So just a quick introduction by myself, but first I'm going to do a disclaimer. Anything I discuss here should not be construed as any investment advice. I'm not suggesting how to invest or what to invest. So this is kind of the standard disclaimer here. My job here is to present the facts. So I'm going to present to you what's going on in the market, and then obviously you can make decisions based off of that in the future. Obviously, if you do want to get engaged with trading, DeFi trading, things like that, it should be important for you to get more educated. This is not a sufficient session to get more educated around how to trade DeFi, how to do, for example, yield farming and all those other things, and how to generate potentially 15 to 20% APY yield using DeFi protocols. But that's a discussion we'll have later. So a little bit about myself. I'm the founder of a company called Chain House. I also teach at Columbia Business School. I'm an adjunct professor at Columbia Business School, NYU, and CUNY. In those universities, I teach graduate level blockchain, artificial intelligence, and machine learning. Those are the three topics that I teach, both on the business side, and then some of the courses at CUNY are technical coding classes for like machine learning and data science. I also run a fairly popular think tank called a Central Bank Digital Currency Think Tank. It's for academics, meaning it's an intellectual think tank where a central bank comes in and presents a paper. On April 8th, I have the governor of the Swiss central bank coming in and giving a talk about a paper that he just released a few weeks ago. He's a friend of mine, and that should be very exciting. If you'd like to attend, please just contact Angeline and we will make it happen. I also focus on products. Chainhouse builds some products. We have a product called Attaché, which is a DeFi tracker app. I'll tell you a little bit about it later when we cover some of the tools that are available. And I have about 20 years of finance and technical experience. I started coding when I was a very little kid, around 11 or 12 years old. So I do both the technical side of things and I also do the business side, like economic modeling, advising, and things like that. And it's a great time to be in crypto these days. Clearly you see what's happening in the news, but there's a lot more occurring that's kind of behind the scenes. I'm published. I wrote a book called Mastering Corda, which is Corda is a specific type of blockchain. That book did really well. And I'm writing another book for a major publisher. Hopefully that'll be out this year, called the Decentralized Finance Phenomenon. And that'll be a paperback. And it's meant for the casual business reader. Whereas this first book, Mastering Corda, is more for developers. I mean, the book is about 500 pages. It's very technical. And this other paperback that I'll do is maybe about 250 pages and explains a lot of the concepts behind DeFi, because it can be very scary and fairly complex to understand. I also run a very large blockchain meetup group in New York City. We're more than 6,000 people, plus a mailing list of 10,000, all in New York City, all people that are very interested in DeFi, blockchain, digital assets, all of that. Before COVID, we used to do a lot of events. Hopefully we will continue doing more events. Hopefully the last half of this year, hopefully New York City returns to some degree of normalcy, and we will continue to do more events. This is the Attaché app that we're building. We have a beta version of it out. It's basically a way to track DeFi information, like yields and the market makers, where they are at in terms of bids and asks and liquidity pools and things like that. We'll be launching this in about 2 months. We'll be looking to raise capital, and then launch this in 2 months and pick up users, and then potentially pivot those users into an exchange or something else. So we'll see. We also launched just now a Python Instagram page. So a few weeks ago, we got almost 4,000 followers. This is how to code financial things. And I create these tutorials. They're like 5-minute tutorials on how to use Python under 10 lines of Python code to do all kinds of interesting things that we run. And I ran a DeFi conference a couple of weeks ago. We had about 2,000 people. We had 40 speakers, 40 different protocols come and speak. The conference is done, but there is a download presentation link. I urge you guys to download it. It's a 600-page slide deck. It's all these talks combined. We've combined all of their slide decks into one PDF. If you like to get more information about DeFi, it's free. You can just download that. I think you'll find that very, very valuable. And we also launched a website called DeFi White Papers. If you are interested in studying certain DeFi protocols, we make it easy for you to find the white paper. It basically is a catalog of white papers. There, you can just simply click on it and download the white paper, and you get a good idea of the different protocols that are on the market at this stage. Sorry, my phone is, just mute this here. So let's get into the talk today. We're going to cover a brief overview of DeFi. I'm not going to get too much into the details because the details can get complex, like automated market making and constant product formula and things like that. And I'm not going to get into that. That's that kind of topic we cover later in the trading course that we're rolling out. Angeline and I are rolling out, and with her team, Allison and I as well, rolling out. We have a course that covers the details of that, how to trade these DeFi tokens and how to generate yield and profits. So I'm not going to go into the great detail. Also, in the interest of time, I'm going to try to do like a broad overview so you can get an idea of what's happening in the space, the major categories. So we'll cover DeFi, what are tokens, ICOs, STOs, and then we'll get into like stable coins. What is a stable coin? Why do we need a stable coin? And then where DeFi really shines today is money markets and yield farming and automated market making, which is similar to a market maker function that you see in traditional finance with some party that puts up a bid and an ask. In this case, it's all automated. And then we'll look at prediction markets, oracles, and then we'll look at some tools that are available in the market that you can use. And then hopefully we can then get into Q&A. I'm going to try to go fairly fast. I'm under the assumption that this is going to be recorded. And then if somebody didn't understand something, you can always go back to it. And then if you have any questions after this session, please contact Angeline and she will forward it to me. Okay, so what is DeFi? Some people have heard of it. Everybody pretty much has heard of blockchain or Bitcoin. Maybe not everybody understands how it works, but you see in the news. And DeFi is a relatively new thing, right? So it's a new thing, and it's a new term, but it's picked up speed quite a bit in the past 8-10 months, especially after COVID. So what is DeFi? It's the whole idea of taking all the finance that we're used to, whether it's real estate or money markets, like opening up a CD in a bank, all of that traditional finance stuff is now being moved onto the blockchain without an intermediary. So there's no bank involved. It's just code that is doing basically what banks used to do, or banks do today, which is they offer you put a deposit in, you get 2% return. If you're lucky, 3%. Right. And in the process, because it's codable, you can code these economic models. I can take an economic model that I have in my mind that may not exist in traditional finance, something that Wall Street hasn't created. And I can financially engineer completely new economic models and code it into a smart contract, or basically, which is this code that runs on the blockchain. And I can see people then interact with that code and create trading capabilities and arbitrage capabilities, and so on and so forth. But it's fairly complex, and it's getting more and more complex, much like how derivatives are complex. This is actually getting more complex than derivatives. And I gave an example here, a protocol. A protocol is basically a DeFi product called Uniswap. It's about 300 lines of code, which is not a lot of lines of code. But with Uniswap, over $100 billion in trades have been made since it started. It's in about a year and a half, 2 years ago when it started. About $100 billion in trades are made, and that's growing rapidly. So imagine what you can do with a very small amount of code, and you can then deploy that code on a blockchain, and you all of a sudden created this economic capability and with a set of features. And there is no one party that can control it, right? So there's no bank that can shut it down or anything like that. And that's considered to be decentralized, right? The idea that there is no one entity that can alter the program. So that's exciting. And what does it mean for us as a civilization, all of humanity? What DeFi does is it makes finance available to everybody, right? So potentially some kid in some village in, let's say, in Vietnam or somewhere, wants to invest in DeFi as long as they have internet access or a mobile phone, which almost everybody does these days. They can start to interact and generate revenues and trade. And so the access point is global. It's not based on borders, right? So if somebody's sitting in China, can they trade US equities? They have to go through a process, right? And vice versa, if somebody wants to trade on a Chinese stock exchange, I can't just get up and just start trading. I have to go through a process to open up an account and all that kind of stuff. And then the idea is with DeFi is that because it's more open and broadly available, those that are unbanked, those are part of society that don't like to use banks or don't use banks, may find this appealing, and we can kind of bring in an entire sector of society into this financial phenomenon. Especially those people that don't have access to banks. Somebody sitting in a farmland and has just a phone and just believes in holding cash. With DeFi, the market is open 24/7, right? There is no such thing as a closing price and opening price because it never opens and it never closes because it never closes. It opens once and it just stays open. The ability to trade can occur at any time. The New York Stock Exchange and US equities, as you already know, closes at 4 p.m. There is some after hours trading, but in general, the market closes at 4 p.m. And that's not the case with DeFi. So all of these attributes about DeFi make it very, very appealing. We'll see soon why this is also still very early stages for this, and there's some risks involved, and there's some questions that still remain to be answered. And we're going to see that emerge in the next few years. So let's turn the clock back a little bit. Everybody, I believe, here has heard of Bitcoin. You might not fully understand how Bitcoin works and things like that. But the main thing that Bitcoin has solved is not that it's created a cryptocurrency. That's not important. And we can argue that Bitcoin is not a currency at all. It's a speculative digital asset, right? But the main thing that Bitcoin solved was this notion of double spend. If I have some digital thing, and if I give it to you, I still have it, right? So if I email you some photo, some digital photo, I still have a copy. And that's called double spend. I can share that copy with anybody else. And therefore the value of that digital thing will be zero, right? Because anybody can copy and paste it. And so it has no possibility of having any kind of value. What the blockchain does is allow for me, if I send you a digital asset, I will no longer have it, right? So that ability to move and transfer a digital asset now allows the possibility for that digital thing, whether it's a piece of art or what we call a cryptocurrency, to have some value, potentially to have value greater than zero. And that's what the blockchain solved, is the problem called double spend, right? And it's Bitcoin blockchain also introduced the idea of decentralization, which means there is no single point of authority that can control the system. There's not one party. Like, for example, with Gmail, if you use Gmail, if Google decides, or Alphabet Incorporated decides to shut down the servers, you're going to lose all your emails, right? So that's centralized as a single point of failure, right? It's a single point of leverage and control. And if Google decided to charge you $2 a month or $5 a month for Gmail, at this stage, you might pay for it because you might not have much choice else to change your email address. So many people know about your Gmail address. And so you're kind of stuck. And that is the power of centralization, which is the participants join it. And once the central authority recognizes that it has control over the participants, it reaches a critical mass where it can now extract value from the participants. And that is seen as a problem in the decentralized space. So decentralized means that there is no one entity that can shut the entire system down or force people to do anything. Doesn't matter how many people are on the blockchain. Decentralized means there's no one party that can control it. And that's what Bitcoin introduced, right? It introduced this ability to mint Bitcoins using an economic system of what's called mining. You solve a cryptographic problem. You burn energy. There's a cost to producing Bitcoin. And the blockchain, Bitcoin blockchain brought this to the front and center. Say, this is what we can do. That's basically the genius of the inventor of Bitcoin, somebody named Satoshi Nakamoto. But there were some problems with Bitcoin. In Bitcoin, you can only transfer as a Bitcoin between you and somebody else, and that's the only thing you could do. The data of the Bitcoin stores ledger information or transaction information. I send you one Bitcoin. That transfer is stored on a ledger on a Bitcoin blockchain, and that has a specific data structure from, to, the amount, timestamp, and that data structure is very, very rigid. You can't do much more than that. And that was seen as a problem in order to extend the ability of Bitcoin to be able to do other things, the Bitcoin blockchain to do other things. It actually was not really possible. So then what emerged was a different blockchain called Ethereum. And with Ethereum, I can customize and define my own data structures that sit on the blockchain. And those data structures, whenever they're modified, it's modified in a way that everybody can see it in a decentralized way. That ushered in the idea of tokens, right? So that caused the idea of tokens to emerge. Say, hey, I can store on a blockchain some arbitrary value, 1 million, 10 million, and I can say, well, out of that 10 million, I've given this person 500, I've given this person 200, I've given this person 600 tokens, and I can do that. And that launched this idea of tokens. And we saw this much like Bitcoin blockchain has a currency called Bitcoin. Ethereum has a currency called Ether, but based on Ether, you can create tokens that are translatable to Ether, right? And so one of the first use cases that emerged, and this is 2016, 2017, 2018, before the SEC got involved and to try to prevent some of these because they turned into be securities instead of just assets, is the idea of tokens. And a token was basically an allocation table sitting on the blockchain. So it's basically a table like a spreadsheet with just two columns, right? Somebody's wallet address, kind of like your bank account number, right? And the number of tokens that that person have, which is just a number sitting in an allocation table, right? It's just a, hey, this person has 500 tokens. It's arbitrary, and I can make that number whatever I wanted to. And based on that, people sold tokens. Say, hey, I'm starting a project. Here's the allocation table for that project. If you want to benefit from this project, please buy some tokens. And this idea of ICOs, kind of like IPOs, emerged, right? The idea that I can issue tokens, I can issue 100 million tokens just like that within 5 minutes, and I can bring in people to invest in my project, kind of like crowdfunding is globally how you do crowdfunding. So ICOs became very, very popular. They were unregulated when they were very popular, and then the SEC came in and started to regulate them. And that kind of closed that whole phase down, and it reemerged as STOs, which is called security token offerings, right? You see here, basically, the SEC doing certain actions against people that did ICOs for large amounts of money. And then the ICO market just collapsed. And what then emerged was the STO market, which is basically a token that you issue, but you register that token with the SEC, kind of like how you register an IPO with the SEC before you go out to the public and raise capital. So the STO market is still vibrant, but not as big as it was with the ICO market. It's a regulated market. But what it showed is that it's possible to bring investors onto the blockchain and do all kinds of activities, right? You can create all kinds of potential activities on the blockchain, and people will put their money in and engage, whether that's trading or farming, what's called yield farming. But the ICO and the STO boom gave people the idea that we can do other things that with crypto and tokens that were probably not possible ever before in human civilization, right? So that launched this idea of asset tokenization. I can take an asset, like a barrel of gold, and I can issue tokens against that barrel of gold, or 100 barrels of gold. And basically, if you own a token, you own a percentage of those barrels of oil or gold or whatever it may be, like, you know, a vault full of gold. That became asset tokenization. So the next phase after ICOs and STOs was this idea of, hey, I can tokenize assets. I can take a house and I can break that house into ownership of that house into 100,000 pieces. Anybody that owns one of the 100,000 tokens owns an appropriate fraction of that house, right? And it's the idea of, like, I can now sell assets and tokenize assets. I can fractionalize assets and trade those tokens. That started to emerge, and we had platforms that came up and started to do that. So how it would work is basically you have an issuer, they put assets with a custodian. Imagine like a big vault, and I put 100 bars of gold in that vault. There's an auditing company that verifies that the 100 bars of gold are there, and then I go to the Ethereum chain and issue tokens against that vault, the contents of that vault, and anybody that owns the tokens owns some fraction of that vault of gold, and that's what became known as asset tokenization. It hasn't emerged as the most popular use case on Ethereum, but this is kind of the stepping stones towards DeFi, right? So these are things that people started to say, hey, let's play with this. Let's create tokens that can do all kinds of things. And that became kind of the stepping stone for what DeFi is today, right? And here's an example of some companies that are tokenizing real estate. Now, what this led to is the idea of tokens, and then there were different types of tokens. And you may have heard of NFTs. So in general, there are two types of tokens, two ways to classify tokens. One's called fungible, right? Which means if I have that token and you have that token, if we trade it, there is no economic loss either way. So the same thing, if you have a $5 bill and I have a $5 bill, and I give you my $5 bill, and you give me your $5 bill, assuming none of it is counterfeit, then there is no net gain or loss for me, nor is there a net gain or loss for you. But if I have a token that represents some property somewhere, and you have a token that represents some other property somewhere else, there's a high chance that if we exchange those tokens, that somebody's going to take a loss for something, right? Because all properties are not the same. Every property has different valuations, different features. So the tokens are not the same. So a non-fungible token is a token that represents a specific asset, one specific thing. It could be artwork, it could be a house, it could be some image. The person that possesses that non-fungible token is implied that the person then owns that asset, that unique asset. So what started to emerge is the idea of fungible versus non-fungible tokens. Fungible tokens were used, and you can think of Bitcoin as a fungible token. If I give you 1 Bitcoin and you give me 1 Bitcoin, there's no big deal. Nobody loses anything. But if I trade a non-fungible token that represents real estate, and you trade that with me, one of us is probably going to take a loss. Let's say I've got an apartment in Manhattan and a condo, and a token that represents that condo, and you've got a mansion in California. Both are tokens. They're one token that represents each of those properties. We will not want to trade. Maybe I will want to trade. I will give you my tokens for your token, but you probably will not want to do that, because that mansion in California is going to be worth a lot more. So non-fungible tokens are tokens that are tied to specific asset that is unique, and that asset is typically can be anything like real estate. It could be digital art. Okay, and I put up here in the slide deck some economic ways of thinking about NFT. This kind of economic thinking is not in the market yet. I'm going to include it in my book, and I do cover it in my classes. How to think about NFTs in terms of trading NFTs. The probability is equal or greater than 0 that if you trade a like NFT token, that somebody's going to take a loss. Whereas with fungible, the probability is 0 of you taking a loss if you trade a similar token. And so NFT started to emerge around this time as another use case of using tokens. And the NFT craze, if you looked at what's occurring in the news the past month, has gotten to a really high level. There was an artist named Beeple that created an piece of artwork, a digital artwork, and that sold for about 70 million by Christie's auction house. And so the person sent $70 million, and they got this one token that represents this specific digital artwork that was created by Beeple. And if you go to FinPython, I show you how to use Python code to track that NFT. And see, you can see where it is, how it's moved on the blockchain. So the point here is then, after these asset tokenizations emerge and the idea of a non-fungible token emerge, because if I have a piece of real estate, I can have one token that represents that. And every house that's in a portfolio of property, each house can be represented by a specific non-fungible token. So it open up this new world of possibly different types of tokens and trading different types of tokens. And we see now that the non-fungible token market kind of is exploding and growing fairly rapidly. Now, at the same time, if you look at the pricing of Ether and Bitcoin, the prices are extremely volatile, right? So people say, well, it's a cryptocurrency, Bitcoin is a cryptocurrency, or Ether is a cryptocurrency. My response is that it's not a currency at all, because some of the properties of a currency, they're listed here, like store of value, unit of account, legal tender. I mean, I can go to a store and use it, and medium of exchange. One of the things that Bitcoin doesn't do well is provide constancy, kind of a constant value of store. So if you buy Bitcoin now, you're not going to buy Bitcoin now so that you can use it to buy milk. You're never going to do that. You're going to buy Bitcoin now in the hopes that the value of that Bitcoin goes up, right? That's the only reason you would buy Bitcoin. You will never buy Bitcoin to buy a Tesla, right? Because you can just use cash, right? There's no reason to use Bitcoin for that. So the only reason you would buy Bitcoin at this point is to get what's called the greater fool. Here's my Bitcoin. I bought it. Now I need to find a bigger fool who can buy it off of me for a higher price, right? And that is not the nature of currency, right? So currency cannot have that kind of psychology around it. Currency is that if I'm going to get that currency, I will use it to buy milk and cars and eggs and whatever else, my daily affairs. I should be able to use that. So in terms of store of value, Bitcoin fails as a currency, right? But you can consider it as a speculative token that just happens to be very, very popular, right? So the nature of its store of value, the ability to store its value, is a problem because that value is very volatile, right? If I buy one Bitcoin today for $100, let's say, and tomorrow it might be worth 300 or it might be worth 50, I don't know, right? And so that can't be a store of value as a currency. That can't be the case, right? It's not reliable enough. And if you look at the volatility, here's a volatility chart of Bitcoin, and you can see the volatility going up to 15, right? In some cases, going up to 10, 20, it's going up to 10. That's not prices, that's standard deviations, how many standard deviation the price moves away from the average, right? And so these standard deviation spikes up and down are very, very, very drastic. And typically in Wall Street, if something is has pricing volatility of 3 standard deviation, it's considered extremely risky, right? The asset's considered extremely risky. And here you have an asset called Bitcoin that has volatility potentially up to 10 standard deviations out. And so it's considered some type of asset, but maybe a speculative asset, definitely not a cryptocurrency in the true sense of the definition of currency. And Ethereum is the same. You can look at the volatility of Ethereum. And because of this volatility, what emerged in the market is the idea of a stable coin. Now, let's say I'm an employer. I want to pay my staff, my employees using cryptocurrencies like Ether or Bitcoin. I can't do it because the minute I pay them, they hold on to the Bitcoin, and then 2 days later, it might be worth half. And people don't want their salary and their savings to be cut in half, especially because they worked for it. So the volatility was a problem for these cryptos. And so what emerges the idea of stable coins. Basically, it's a token, much like a Bitcoin is a token and Ether is a token. It's these tokens where the supply and demand is algorithmically managed, right? The algorithms manage the supply and demand of that token such that the token is redeemable for $1, 1 USD. It's kind of pegged to 1 USD. It's not a forced or a fixed peg like that you have in the FX world, but it's an algorithmically adjusted peg. It can be either hard pegged or soft pegged, and there's different types of stable coins. Some of the early stable coins when they first came out, like for example called Tether, and I'll show you some screenshots of Tether. What they did is they were collateralized. There was an asset-backed stable coin. So I took $100 million, put it with a custodian, and then from that $100 million, against that $100 million, I issued 100 million tokens. So anybody that owned that token, one token, would have the ability to redeem that one token for $1, right? And that allowed the value of that token to stay around $1, right? And that was necessary. The need for that token to hover very closely to $1 was important. And that is called a stable coin, a coin that has a very narrow trading range. It doesn't move up and down too severe. It's typically hovering at $1, right? Its price, if you go out and sell it in the market, you're going to get roughly around $1, maybe 98 cents, maybe $1.02, $1.02, right? But that's called a stable coin. And there are different kinds of stable coins. I can park cryptos. I can take $100 million worth of Bitcoin and park that and issue tokens against that. And that could be stable coins. But what is emerging and becoming probably the default way of doing stable coins is algorithmic. So the minute the price of a stable coin starts to descend, then there's incentives for supply to be burnt away, right? Or if it rises too high, then supply is increased into the ecosystem such that the price of the peg ratio, it goes down and is balancing around $1. So there's a bunch of stable coins that started to emerge. We're talking about 2019, 2018 started to emerge. Tether is one of them. The symbol is USDT. They put $100 million in a custodian, but they had some problems. There was questions around, do they even have that money with a custodian and things like that? And that kind of like became front and center. Coinbase, which is a crypto exchange, also issued their own stable coin called USDC. And you can go into Coinbase or you can go into the open market and buy 100 USDCs for $100, right? And then you can use that USDC for other things. And then if you're an employer, that gives you stability around your payroll, right? What you're going to pay and what you're not going to pay to your employees. If there's no volatility, you know that you're going to pay your employee this Friday $500. Then by Friday it will be only $500 that you have to pay that employee. It won't be like, oh my God, it's now the price of that token has tripled, or even worse, it's gone down and is worth 1/3. So that stability was needed in the market. That caused the emergence of stable coins, and that started to fuel DeFi, right? And one of the more successful stable coins is called MakerDAO, or Maker, just called Maker now. And they issued a 2-token system, but the stable coin is called DAI, and it's very, very much in use. It's kind of the core foundational piece in DeFi. So the DAI is significantly traded in the DeFi space with other protocols, right? So I want to park my cash into a stable coin. I can go buy the stable coin, and then using that stable coin, I can do lots of different crypto type of things. Once I enter that kind of space with that stable coin, I can do stuff with the stable coin in the crypto world. I can't do stuff in the crypto world with fiat currency. It's sitting in the bank. I can't do anything. I need to convert that into something that's in the crypto world, which is stable coins. And I want it to be stable. If I buy $1,000 worth of stable coins, I want it to be worth $1,000 next month. And stable coins do that. And the most popular one right now in the DeFi space is called Maker, right? And they also have another token. It's a 2-token system. One's called DAI and the other one's called Maker. The Maker is given to governance people. You can manage and govern the rules that are used, the coded rules, the algorithms that are used, and the people that manage that algorithm are incentivized by using and receiving what's called Maker token. I'm not going to go into the details of how the system works. It's fairly complex, and we will leave that for the DeFi trading course that we were rolling out. So we'll get a lot more detail in there. And how do I buy DAI? How do I trade DAI? How do I use DAI to collect a yield, a 10% yield somewhere, 5% yield somewhere? We'll cover that in the trading class, right? Okay, any questions so far? I just wanted to make sure, quick 5 seconds. Anybody have any questions? No, okay, great. So
I have a question. So so if people now find the volatility of Bitcoin is too high, so is there a way we can sort of control it, or is there anybody saying the way we create short sale trades, or do we use some derivatives to control the volatility of Bitcoin so that it can be stable? You don't have to create a separate stable coin, but you just do it. Make the Bitcoin as more stabilized a little bit, to be more similar to a currency. I mean,
yeah, there's
not instead of being like as a wired equity, make it more similar to a currency.
Yeah, there is no real mechanism to control the volatility of Bitcoin, because that's not part of the Bitcoin protocol. Like the Bitcoin itself, the rules that it follows based on the white paper that Satoshi originally wrote, and some of the rules have changed, but there's been no way to control the volatility of Bitcoin. Now remember, one thing to note is that mining, which is done by only a specific number of people in the world, where they're earning and minting Bitcoins for the first time, they're playing effectively a lottery, right? So the ecosystem at its source is very speculative. So in order for you to mine, you effectively are gambling, right? Because you might not make money on your mining. And so you're basically gambling. And therefore, you can think of Bitcoin as emerging from an environment of gamblers, right? And therefore, because these gamblers are speculating, you're going to introduce that speculative behavior into the ecosystem, whereas they're going to buy and sell Bitcoins, even though they are mining, and trade it away. And that's increasing, that has caused the volatility. What will slow the volatility down for Bitcoin is if it's pervasively adopted globally and not a lot of people, it becomes normal. Everybody is like, yeah, I've got Bitcoins. Everybody has Bitcoins. And then I think the volatility will potentially drop. But we'll see. That's just a thesis. That's not necessarily, we don't know if that's the case or not.
Okay, thank you.
Yep, sure.
Can I ask a question as well?
Sure.
So what I heard is like people are saying like when the quantum computing comes real,
Yeah.
that's going to be the end of the decentralization and as well as the Bitcoin. So like for the centralized system, they can like limit how many times you put in the password, but for the decentralization, you won't be able to do that. So eventually, like the quantum computing would be able to figure out everything, right? Like it's just so would that be the end of Bitcoin?
So that's a great question. Both questions were great. One is, and I'm studying quantum computing now. In terms of coding quantum computing, it's not easy, but the power that we have with quantum computing is nowhere near the power that's needed to crack the cryptography behind Bitcoin. So unless there's a sudden surge in innovation around quantum computing, the trend line about quantum computing right now shows that it's not enough to crack the cryptography that exists on a Bitcoin blockchain. Now, as quantum computing develops and becomes more and more powerful, there's a community of Bitcoin developers that will keep up with that, right? And so it's not going to be that Bitcoin is completely unaware of what's happening in the quantum computing space, that the developers that are still developing the Bitcoin protocol, fixing it, adding new features, removing bugs and things like that, that they are not aware of this. They are fully aware of this, and they will then adjust the blockchain as quantum computing becomes more and more powerful. They will adjust it automatically. And there's some blockchains out there. There's one like called IOTA, and there's a few of them that they consider themselves quantum proof. Even quantum mechanics and quantum computing cannot crack it. So it's like a chicken and mouse, or cat and mouse thing, right? The mouse gets smarter, the cat gets smarter, the mouse gets smarter, all right? And the cat's trying to catch the mouse is trying to run away, right? And both of them keep getting smarter and smarter, and they never catch each other. So, so that's going to happen with quantum computing. I think the kind of power that we need is at least 20 years away. And in 20 years, Bitcoin will be something else. It'll be, the developers will make it into something else by then. So, but we'll see. If tomorrow morning there's a breakthrough in quantum computing, then yes, Bitcoin could be in trouble potentially.
Can I also continue a new question on that?
Yeah.
So, because you said it's like a cat and a mice, right? Like in the normal banking system, there is an insurance. So there are also like people get like a scammed, right? They lose the money, but there is an insurance guarantee, like they can get the money back. But for the Bitcoin, you don't have that guarantee. So my question is, like the cats is going to get some of the mice. So which means some of the people who's holding the Bitcoin may lose their money. Like, what do you think about that?
Yes. So there's multiple answers I have for that question. One is, you're right. When you're buying Bitcoin, you're taking some risk, but that's the type of people that buy Bitcoin. They buy it because they're holding, and they understand the risks behind it. It's entirely possible that some major discovery occurs tomorrow that causes the Bitcoin value to just go down to zero. It's entirely possible. But that being said, there are other ways to buy and trade Bitcoin. And we cover some of this in the crypto trading class that we have. Like you can buy options and you can do other kinds of things where you're not fully exposed to Bitcoin. You can hedge. There's hedging techniques. And then in the DeFi world, there is the notion of insurance and coverage. So when you deposit in a bank account, you get FDIC coverage. I think it's about up to $100,000, maybe a little bit more now. I don't recall, but those things are being built in the DeFi space such that when you park your tokens and you want to generate 20% yield on those parked tokens, you bought Ether, you want to park it, you bought Bitcoin and you want to park it and generate interest income, you can do that. And if something fails, you might be able to collect on an insurance contract that also is on the blockchain. And so there are companies that are looking to do that. So yes, you're right. There is some issues. There is a risk that you take when you go into Bitcoin and Ether. But those risks are being mitigated over time. More and more innovation is coming into the space to say, well, if an investor comes in and they lose their money, can we create an insurance product on the blockchain? And there's a DeFi protocol called Nexus Mutual that is doing exactly that. So if you are holding cryptos and for some reason it loses all value, you might be able to collect on insurance. But those things are emerging. I'm going to touch upon a little bit of that, hopefully in about 10, 15 minutes on some of these protocols that are doing that. Does that answer your question?
Yes, thank you so much.
Sure. Yep, sure. So I'm not going to go into the details of this Maker DAO contract. I'm not going to cover the details of this. That's for a separate class. But you guys are welcome to the slide. I'll pass it to Angeline and she can pass it out. But this is generally the Maker contract, which is a stablecoin, is fairly complex. You can see this is the time series for the Maker token. Sorry, for the DAI token, and it's generally stable, right? You can see this over a 1-year period last year, and it's the same for this year, that it's hovering around $1. It does not have the same volatility as Bitcoin and Ethereum. So this has allowed this kind of safety feeling around this token. Say, well, I'm safe with the DAI token. If I park $1,000, I know that it'll be worth $995 or maybe $1,050 around there, and it's fine. I can keep that. Kind of like I'm comfortable with that for now, as opposed to Bitcoin and Ethereum. And algorithms are used, economics incentives are used to make sure that the stable coin stays around $1. For example, there's collateral. When you buy DAI, you put up collateral, and then when the value of the DAI kind of goes down, people come in and buy more of that collateral, so that pushes the price up of DAI, and up and down. There's incentives to sell DAI if the value of DAI is too high. There's incentives to buy DAI when the value of DAI is too low. The point is that these algorithms, which are open source, anybody can look at it and study how they work, can use it to understand how stablecoins work, right? And this has become successful, right? This is becoming adopted globally. Unfortunately, the people that know DeFi are like the same people, the same type of people, or the same number of people that understood blockchain 5 years ago. Right now, everybody talked about blockchain. Actually, on Saturday Night Live, the comedy show last night, there was a whole comedy skit on NFTs, right? So you would, like 5 years ago, they would never do that. So DeFi is still in its early stages. Very few people understand it. People are still figuring out Bitcoin, but DeFi has moved really beyond that. And the core of DeFi, it's one of its foundations, is based on Maker and the DAI token, as we'll see if you play with some of these protocols. Okay, so I'm not going to get, this is a kind of rough diagram of all the different pieces, the different smart contracts that are running and operating to make the DAI and Maker token system work. I just put it this there so you can have an appreciation on some of the complexity that's involved. Obviously, if you can understand its complexity, and it's not very difficult to understand all of this, you can find ways to make free money, right? It's because the market is so young and so new and so potentially, I don't want to say unstable, but it's still irrational. There's a lot of ways to make money on this, right? So with that, when once stable coins started to emerge, people put their fiat into stable coins. I'm going to buy this stable coin. I'll park $10,000 into the stable coin. I can use it for other things. And once they had that $10,000, much like you have your $10,000, if you have $10,000, you're going to say, well, let me earn interest on this. How can I earn interest on this? Why should I just hold it here? Or let me invest it. I just don't want it to sit there and let inflation erode its value. So what started to emerge was called liquidity pools, or money markets, where I can go out and take tokens that I have, and I can give it to the blockchain in a smart contract, and I can earn a yield on it, right? Much like a bond or a CD, I can earn yields on this. And so that what came about, what emerged from that is the idea of liquidity provider. You've got $10,000 worth of maker tokens or 10,000 DAIs sitting in your wallet. You're like, well, I want to park this somewhere. So then you will go to certain of these protocols, like a protocol called Compound, and say, hey, here's 10,000, give me 7% return. And that protocol will be willing to do that. And on the flip side, there'd be other traders that are willing to buy and trade the DAI token and pay 9%. And then there's a spread that the smart contract can take. So that's kind of emerging, this what's called money markets. And you can see that it's starting to replicate traditional banking, right? One of the foundations of traditional banking is money markets, right? CDs and savings accounts and all that. Those are the money markets. And now DeFi is now replicating that basic core function of banking, and it's doing really well, right? And it's growing really well. So there's a bunch of platforms that do that. Compound, Aave, Dharma, Celsius is an example of centralized. Last time I know the CEO of Celsius, the last time I had a conversation with him, I think they were up to $1 billion that they were managing or something like that. I forget, you're right. Some significant number of tokens that they were managing. You basically park your tokens with Celsius and they give you a yield. And Compound is an example of a decentralized money market, and they've been invested in. They raise capital through Coinbase and Bain Capital. If you've heard of Bain Capital, is a major consulting management consulting firm, right? So there's many of these money market platforms that have emerged. And if you go to DeFiWhitePapers.com, you can see a bunch of them, who they are, and you can study how they do things. Every one of them does money markets slightly different in a different way. And we'll see how they're starting, which one's the winners. A Compound, for example, is one of the winners. And so the way it works is a lender puts their crypto into the blockchain, into a smart contract. It gets locked up. That's called a locked up value. I have $10,000 worth of USDC tokens or some stablecoin or some DAI. I can park it into Compound, and Compound will pay me 5%, 7%. On the other side of that is some borrower who's coming in and borrowing that money at a higher rate because they believe that they can use it for something else, right? And that market has kind of grown. Okay, that's grown significantly into the billions, and that trajectory of growth looks like it's going to be sustainable, and we'll see like 5-10 years that this potentially will change how we do banking completely. So here's a screenshot of Compound. You can see the supply markets on the left. You can see that here, if I deposit DAI, let's say I buy DAI for $1, I buy 10,000 of them, I can deposit and I earn a pretty nice yield, right? 6.3%. And then if I borrow DAI, I have to pay 8.92%, right? So you have a full money market system here that's operating. So money markets have emerged, and I'm not going to cover how Compound works. That's also in the DeFi trading class when we get to it, how to use it. So what this has forced is the idea of yield farming, right? The yield farming is, hey, I'm going to park my tokens and wherever I can find a maximum yield, because there's so many different DeFi apps out there, DeFi protocols out there. This one's offering 7%. This one's offering 7.2%. This one's offering 8.1%. I want to go wherever the yield is the highest. And these yields change every 10 minutes, right? It's not like a bank where the yield, what you see, the yield, that's the yield for today, tomorrow, day after tomorrow. These yields are changing every 5-10 minutes. They're adjusting. These yields are calculated using an algorithm. And as the market shifts, the yield shifts. And so what has emerged are tools that help you take your token and find the best yields, kind of like a money manager or a capital allocator. But this is automated, right? So the yield farming is automated. And an example of a protocol that does this is Yearn Finance. And actually we had them in my DeFi conference come in and speak. Basically you park tokens with them and they will move your tokens around to get the best yield. They're kind of doing automatically the hunting and parking of the tokens for you, right? So you can see that this is now starting to become layers and layers on top of the original idea of just the Ethereum token or a Bitcoin. There's a lot more complexity and layers. A lot more services are getting involved. There's a lot more ways to do things in order to make money in the crypto space. In our trading course, we go through how to use Yearn and how to, like, with, you know, take $10 and buy DAIs and then go out and park it with Yearn and how does that work. We go through that whole process. And then the other area, which is really big, so it's money markets. That's really, really popular in the DeFi space, and introduce the idea of yield farming, is the idea of exchanges. Now, when you go buy stocks, you're basically effectively, you're working with an exchange, right? The exchange is doing the crossing and the matching and all that. In the DeFi space, exchanges are very, very different. There is the notion of automated market making, right? So you have your traditional crypto exchanges that are centralized, like Coinbase and Gemini and Binance. Then you have this whole decentralized exchanges. The biggest one right now is called Uniswap, and there's a very close second called SushiSwap, and it works on a very different model than the traditional exchanges work, right? The market making is automated. Typically, when you have a market maker, it's typically a human being on the other side who's willing to buy or sell a certain equity at a certain price. Here, this is all done through algorithms, right? So, and it's bifurcated. The market is separated into two different components, right? Let me just go into what these components look like here. And I'll come back here. This is kind of how the components look like. So imagine this is the Uniswap money market component here, right? A trader wants to trade ETH for DAI, right? So they'll trade, and you can think of Liquidity Pool as a bank account. So you, as a liquidity provider, you have Ether and you have DAI. Like, I'm sitting on this, it's sitting in my wallet. I'm not earning anything. I can then take both of them and park it inside of this liquidity pool, kind of like a bank account. I can park it into a bank account because I'm providing two different tokens, and the protocol requires that I send in only two tokens. I must send in 2 tokens, right? Then those 2 tokens are available for the trader to trade with. Like, they can take sell one and get the other, or sell the other and get the first one. They can trade, and those trading fees that the trader faces is then poured back into the liquidity pool, and that becomes a potential yield for the liquidity provider. So if you are now parking your $10,000 worth of DAI, you are a liquidity provider, and you did $10,000 worth of Ether as well. So you parked $20,000 worth of tokens. The trader can trade between ETH and DAI. They need the ability to trade between the two because they're doing arbitrage or whatever their strategy is. But whenever they do a trade, there's a transaction fee that they pay, and that fee is accumulated into that bank account, such that when you pull out your money, you get a proportion of the collected trading fees. So that's how you generate your yield. And that's how Uniswap works, right? And that's how the traders in Uniswap have done over $100 billion worth of trade. Okay, and I think $100 billion is great. It's a starting point. In the grand scheme of things, it's not much in terms of what's happening in the equities market and everywhere else. But the fact that it got to $100 billion so fast is an indicator that this is probably going to be the future of how finance works. It's going to be DeFi. My personal opinion, DeFi will be how we do finance in 10 years. It will not be like how we have finance today. And it will be global, right? And it was going to put pressure on a lot of governments and regulatory authorities. And we'll see a little bit of that soon. And then there's some screenshots I showed how actually to like be a liquidity provider. You put in liquidity. This is a Uniswap screen. I'm not going to spend time on this. We covered this in the trading course in more detail, so you actually go through the process and learn how to do it. Also, what has emerged in the DeFi space is called prediction markets. It's effectively a fancy word for the word betting. I can bet on things, right? There's a bunch of platforms that do that, or protocols that do that. Agor and Gnosis are examples of 2 of these protocols. I can bet on almost anything. I can create a bet. I can say, well, I want to bet that Joe Biden sneezes this week. By Friday midnight Eastern, there will be a video of Joe Biden sneezing somewhere live, and I can place that bet, and then there'll be counterparties that can take that bet as well, or the opposing side, and there are odds, and people can come in and join in on that bet if they want, right? So if you go into these markets, you'll see that like Augur, if you go to Augur, you'll see all kinds of bets, right? I like to keep this screenshot. There was a bet on whether Donald Trump is going to win the 2020 elections. You can see that no was higher than the yes. So what this also means through the betting market is you can get potential market sentiment, you can get market information, right? There's a whole host of things that these prediction markets can provide that can potentially be useful in trading. And you can use tokens to trade this bet, or this is basically a bet. I'm going to bet if Donald Trump is going to be win the election or not. And obviously, if you pick no, then you made money, and if you pick yes, you lost some money, right? And so these are called prediction markets. These are part of what's new and growing rapidly in the DeFi space. And if you know anything about Las Vegas or Macau, and I've been to Macau, gambling is a big deal everywhere, right? It generates lots of revenues. But in this case, it's decentralized. There is no casino. There is no blackjack dealer or anything like that. This is all done transparently through open source smart contracts, where you can see the rules of the game clearly through the code, as long as you understand or have somebody who can interpret the code for you. Okay. The other area we see DeFi emerging is the concept called oracles. Oracle is basically the idea that I have all this information that's not sitting on the blockchain, that the blockchain needs in order to conduct some type of transaction, right? And the way that it gets that information, it could be the price of equities, it could be the weather, it could be any number of things, is through a concept called Oracle. And Oracle is basically this server, which when the blockchain communicates with that server and says, give me the price of equities for IBM right now, because I have to see if I want to pay somebody something or not, or tell me if President Trump won the election or not. And that external information is brought into the blockchain so that deals can be triggered, right? And that infrastructure that does that is called oracles, right? And there's a bunch of platforms in the DeFi space that are creating these oracles. The most popular is called Chainlink. They actually have their own token called Link that's done really well in terms of appreciation. And so there's multiple use cases of that. Here's an example of Chainlink. And I can go to some off-chain source. I can go to New York Stock Exchange or anything else. I can pull that data in and bring it into the blockchain so that it can settle some logic that needs to be evaluated, such that from that evaluation, somebody gets money or somebody loses money, right? And that's called oracles. And this is a little bit of technical stuff there. I want to kind of skip it. But this is important to understand that I have a smart contract sitting on the Ethereum chain. It can contact an oracle that gets, let's say, data, crypto data, and then based off that, feeds it into another smart contract, possibly to settle a debt, or, a debt or something like that. So oracles are big business now. People are generating oracles. If you have some special data that's unique and not widely available, you can put it into an oracle and generate revenues for feeding that data into the blockchain for smart contracts that need that data, right? There's ways to generate revenues off of that. So what it means is that blockchain now is not this kind of isolated ecosystem. Now it has tentacles that are extending into the traditional finance world, pulling information from the traditional financial world into the blockchain, right? And that's very, very powerful. And we can spend more time on this when we do our trading course, but this is kind of a general overview that smart contracts are a way to grow DeFi, right? You need more information to come into the blockchain, and the oracles allow you to do that. There's just some technical stuff here. I'm going to skip that here.
Can I ask a question?
Yeah, sure.
This is fantastic. Thank you for telling us this is fantastic. Just a quick question. Say you are saying that if someone has a specific information that worth having some value, then you can actually code it up and distribute it over the internet, right, or the blockchain.
Yes.
And what's going to happen for the material that is copyrighted? For example, not everything has been converted into a copyrighted, thing that you can track over network, right? So if someone have a copy, he's going to be the first one who coded up this, crypto, piece of knowledge, and then start sharing. Is there any way that you can actually? I mean, this is basically a violation of the law, right? So
yeah.
So is there anything that any thought on that? I guess this is going to create a lot of problems.
Yeah. So you're right. It's a great question. It is a question that is emerging in the space around who owns what, but typically an oracle is owned by some legal entity because it requires, it's centralized. It's not typically decentralized. So because it's centralized, there's some legal entity that's behind it. And therefore, if they're violating copyright content, then they can potentially be issued a cease and desist, right? And so they're liable. It's also possible to make oracles decentralized, but that concept of a decentralized oracle is that multiple providers of the same information have equal footing, and so may randomly are picked in a transaction. So you have let's say vendor 1 that provides equity prices, vendor 2 that provides equity prices, the vendor 3 that provides equity prices, and to make it decentralized, my smart contract will pick any one of them randomly, right, and take the prices from there. So at the end of the day, these oracles have to be run by specific entities, and so there is legal recourse in most cases.
Okay.
Yeah, in most cases.
Yeah. Thank you.
Yep, sure.
Hi, do you mind if I ask a quick question too?
Sure, yes.
So for the retail investors, if say anyone invests in Bitcoin is for the speculative value, what do you think is the reason why for a retail investor to invest in a stable coin versus say, if I wanted to invest in treasury notes or, treasury bonds will also give me a kind of very stable return?
Yeah, so you would go into stable coins because you might want to park your stuff into cryptos and be in a position to trade into other tokens, right? And because bringing fiat into the crypto world can take time. It can take a day or 2 days. It can take a week if you move money into cryptos. But once you move into stable coins, you are crypto native, right? It's like saying I moved into New York and I came from London, and the question is, why would you want to convert your pounds to dollars? Why would you do that? Just keep the pounds, but you want to convert it to dollars because then you can do stuff, because now you're in an environment where dollars matter. In the crypto world, dollars don't matter, right? There's no such thing as dollars. So if you are you wouldn't just buy stable coins and just sit there and relax and say, oh, I got stable coins, I'm very happy. You might get stable coins if you're running the treasury of an organization, of a company, and part of your treasury you want to keep in stable coins because you might pay your employees in stable coins because they are globally spread out, and so you don't have to worry about FX exchanges, right? So you're an American company, you have employees in the Philippines, you have employees in Singapore, you have employees, let's say in South Africa. You don't want to deal the FX to pay them. You move everything into crypto, into stablecoin, and everybody gets paid in USDC, for example, right? So that depends on the strategy. What stable coins allow you to do is get inside of the crypto world without risk, or very low risk, right? And say, I want to be into the crypto world and I want to be in a low risk situation. Unless I have a custodian like Coinbase. Coinbase is a custodian. They will hold the fiat for you. So I can park $100,000 inside of Coinbase and then buy Bitcoin and then sell the Bitcoin and it'll go back into fiat. That's not a problem. In a decentralized place, I need a way to store money on a blockchain such that I can then use that thing for any kind of trading I want to do.
Thank you.
Yep, sure.
Can I have a question?
Sure, yeah.
So now, the trading of the cryptocurrency, so what's the portion of retail investor versus institution investor? So I mean, my thought is if too many people are just doing simple buy and hold like retail investors, then the market will be volatile. But if more and more institutions join and doing the risk neutral strategy, like what you mentioned for what the Uniswap guys doing, trade the spread between the two currencies instead of buy and hold, a simple buy and hold, then the market will be more stabilized, right? That's depending on the behavior of the price will be also related to the decomposition of the investors.
Yeah, so that's a good question. I don't think anybody knows for sure. So my opinion is, as more and more institutions get involved, so there is now a shift, to answer your first part of your question, there is a shift from retail people to now institutions on Bitcoin, right? There is more and more institutions getting involved. Before, Bitcoin was just, geeks like me in the basement, like, oh, I want to trade Bitcoins with you. Here's a Bitcoin, give me a pizza. That world is changing, right? Now it's shifting to the retail, from retail to institutional. From corporates are coming in, and like you see Tesla and MicroStrategy, these companies are buying Bitcoin and putting there onto their balance sheet, right? And so you start to see more and more in that. It is entirely possible that all of Bitcoin becomes institutional. And my theory is that if it becomes like that, the price of Bitcoin might come down. Not only will the volatility come down, also the price of Bitcoin will come down, because if I'm an institution and you're an institution, I might settle with you some trade agreement. Let's say you send me 100,000 pounds of sugar, and you're an export-import company. I'm an export-import company, and you sent me sugar, 100,000 metric tons of sugar. I might say, well, let's settle through Bitcoin, and Bitcoin then just becomes a settlement token. It's just a way for settlement, right? And so it can go in that direction potentially. So I think there's going to be this. Yeah, there's a squeeze on the demand is high for the supply, but then once the supply is spread out evenly, then I think the price and the volatility will come down, and then the institutional might dump everything. The institutionals might start to dump when they start to see, wait a minute, the price is going to start to stabilize. Let me get rid of this, and then that could put further downward pressure on the Bitcoin. But that's not going to happen, I believe, and this is my opinion. I don't think that's going to happen in the short term, next 1-2 years. I think long term, 5 years, 10 years from now, Bitcoin will be a different beast, because by then all these other tokens are going to come along that you can do all kinds of other interesting things. So as far as I'm concerned, Bitcoin is a big experiment right now, and nobody really knows where it will go or what it will do. But the shift is occurring from just retail people, just the nerds and the geeks that only know about Bitcoin, to now globally everybody's becoming aware and everybody wants to, some Bitcoins. And that trend continues, and the institutional trend continues. Eventually the institutions will own most of the Bitcoin, just like with equities. It's owned predominantly by institutions, right? And so we'll see what happens at that point.
Yeah, thank you.
Jamil, how many slides do you still have?
I think I got about 4 or 5 more.
Okay, why don't we all allow Jamil finish all the presentation, so then we can get a few minutes of the QA.
Yeah. Okay, sure. So I'm pretty much done. I got maybe 4 or 5 more slides. There are still risks in the DeFi space. I list some of the risks here. A lot of these protocols, like Uniswap actually came up with its 3rd version a few days ago, and the 2nd version was like, I think about a year ago, and the 1st version was a year before that. So like it can show you that these versions of these protocols are coming relatively fast, and they're fixing a lot of bugs from the past, and they're introducing new ways of doing trading and new ways to make money. So, but in general, if the grand scheme of things, if you compare it to the history of banking, this DeFi stuff is very, very new. It's at the edge of very new stuff. There's liquidation risk if you invest something and the counter-currency, your collateral loses its value, and you hit basically a margin call, the equivalent of a margin call. you can lose your cryptos. There's hacks, there's governance issues. The transaction price for some of these things, which is called gas price, can be a lot. For you to just buy $100 worth of cryptos, there might be $50 in transaction fees, right? And so it's still a very young, dynamic market, but if you can find the right strategy, you can make a lot of money on that. Some of these protocols have failures. There's one protocol, a stable coin called Basis, and the Basis, for example, they shut down. This is their goodbye letter, December 2018. They were one of the best stable coins at that time, and then the SEC said, "Hey, you're a security, right?" And they just said, "We don't want to play that game anymore." Right. And so there's regulatory issues. If you're trading from outside the US, there's less of that. But if you're within the US, that regulation is a concern. Some of these protocols are not available to Americans, right? If you're a US citizen, the protocols will not allow you to enter and trade with them. So it's still very young. The risks are very, very young. Here's an example of transaction prices, which is called gas. You can see that late last year, mid last year, there's a spike in the cost of doing transactions, right? The transaction rates. But there's now protocols that are working together to address this. For example, what a protocol might do is say, oh, you want to buy 100 Ether, or you want to buy 50 Ether, or you want to buy 200 Ether. I'm going to aggregate everybody's buys into one trade, and I'll split up the fees proportionally. And all of a sudden, everybody saves money on the transaction fees. And so there's protocols that are doing that as well. So there's a lot of innovation in the space, of creative ideas. Like, wait a minute, transaction fees are a problem. What if we aggregate everybody's trades into one big, massive trade? The fees are going to be about the same. And we do that, and then we disperse the fees and distribute the fees in proportion to your trade. And there's protocols that are out there that are doing that as well. There are protocols that are out there that are creating synthetic options. Coverage, like if a smart contract gets attacked, there's protocols out there that will pay you for just because that smart contract got attacked. So there's multiple different ways and creative ways. DeFi is addressing any of the problems that it has. There's always an innovative solution coming out to try to address that problem. And then there's an example of Yam Finance. They launched August. Sorry, this is not 20. This should be not 2021, but August 20, 2020. And within 48 hours, $600 million went into that smart contract, and then they found a bug in the smart contract, and all that $600 million came back out. So they grew really fast, literally overnight, and then it just crashed down overnight. But they learned a lot, and this team has produced more versions of that protocol. The Yam, I think they're up to version 3 right now. But it shows that there's a significant demand to trade this kind of stuff. And it's a good way to make money. Okay. I think that's all I have. That's all I have. This is the price of Yam. Within overnight, it went from $50 up to $150. Boom, down to zero. So these are some of the risks that are involved. Arlene, that's it for me. That's all I have. Hopefully that was sufficient.
Okay, so we can take 1 or 2 questions. But since we still have 290 people here, I like to share my screen about the reason that I invite Jamie come to give us a talk is because on our platform, there's really a lot of people request, say, a handling. Like everybody know that I always develop class based on our platform, Chinese Coffee Club needs. So this is so I invite him to give us level of the Bitcoin trading classes. I like everybody take time to learn. So if you go to our online Wisdom Academy, you go to course, adult investment. You can find those Midtown class, option class, ETF class coming soon, venture class, and now this 3 that you can see, there's a level 1, 2, 3. And you have to take it by sequence. He and I especially develop this level that from easy, medium, and to challenge. So the first level give you a lot introduction, and also Jamie has his own a cell phone application that for all the students free to use paper trading. So he's very handy, but his class very condensed. Okay, 4 hours class, one weekend, Saturday and Sunday, 4 hours each day. So that is level 1. If you're very interested, you can click on, and all the syllabus is here. Okay, you can find a module, each module 4 hours. So when you come this class, make sure you bring some sandwich and bring some water and sitting there to hear all the fundamental of the Bitcoin and what about the trading. I mean, I might personally always want to do it too. So I want to learn systematic ways from Jamil. And then level 2 is more towards really go to trading. As you can see here, it's advanced crypto trading. And also talking about basically it's all those systems that terminology you just see there, right? It's complete. By the way, the blockchain, crypto trading are very, very complicated. I am not an expert, I have to say, but when I was, investment profession working at a 2 Sigma, I always every weekend I'm very, very passionate about Bitcoin and also the blockchain. So I listen to many conference, and so that's why I also know some fundamentals. So this is the level 2 that towards more advanced trading. And then the level 3 is really for someone running your own, like your own interesting trading platform that tell you how to write API, pull the data from different trading system, and how to writing, in this 8 hours, this is an 8-hour section that on one day, okay, 1 day, 8 hours. And because those teaching has to be continuous. You have to bring all your excitement, join with Jamil. By the way, we also have a New York office open. We get an office, we can probably do on-site on the weekend, and you remote, we will decide what to do. But you can tell, this is to tell you the actual trading within the system. If you are familiar with the VWAP, SMA trading signal, this is called technical, right? Technical, when you are trading daily volatility, this is technical indicators. So this class, 8 hours, is purely just really hand by hand to teach you how to trade in Bitcoin because it's very volatile. Okay, and also, here I didn't mention that, but many people know that we have a kids investment. I actually, for this whole series of the kids class, we have this, we actually asked Jamil, I actually pretty much begging him, said, hey, please give us kids a little bit Python versus small Python flavoring. So in our youth series, and he finally agreed, said, okay, because usually those professionals, they don't really want to teach kids, but as you can see, I have we developed a 4 series of the youth investment, and those are taught by Harvard, Yale graduate, and Wharton graduate, and this 4 series will lead to the Wharton Global High School competition. And I've asked Jamil to teach 4 hours using Python, write time series, and to the data analysis. Actually, this is actually good for adult too, if you wanted to enhance your trading. And I'm really actually want to learn this myself too. So this series will lead to this because last year I bring 70 students to join this competition. I find out that the people who get into final are very, very advanced. Pretty much better than us, right? Like, and master degree, they writing a lot of quantity model and the coding. So for our kids to join this level 1 to 4 to get an experience to 9th grade above to join global Wharton, you should, if you want to win, you should learn a little bit coding, draft a little bit time series, and be able to write some start price forecast. So this is what I'm just want to quickly show you before we get into a couple minutes of the QA. Okay, thank you everybody. You can always find the class online, can just buy there. Okay. So anyone, if you have a question, I would say you can unmute yourself. We will allow 1 or 2 questions. 11 o'clock is our cutoff. Anyone have a question?
Yeah, I have a question. Can you guys hear me?
Yes, very good.
I have a question. Okay. Because nobody can hear me.
We can hear you.
We can hear you.
Oh, you can hear me? Okay. Yeah. I just wonder because like Jamal mentioned this high gas fee on the Ethereum chain, right? So right now doing Uniswap is just not a good deal for like a small amount of money. So that's why a lot of people move to like the Binance chain. I just wonder, because there are so many chains out there right now, like a Harmony chain is also costs little gas fee. And also like there's also chains like Near Protocols or Avalanche. So I just wonder, what do you think about all those different new emerging blockchains out there compared to the existing Ethereum ecosystem, I mean?
Yeah, so I mean, they're all interesting things. I'm blockchain agnostic. I don't have a specific preference for each blockchain, but even though the gas fees are high, there's people working on making that lower. Ethereum 2.0 will probably be more scalable, therefore it can handle. The problem with the gas fees is it increases because of congestion, right? And so if we can ease the congestion on the Ethereum chain, then the gas fees are going to come down, and we do see some of the gas fees come down. But I'm a big fan of the Binance Smart Chain. There's a lot of other. There's a chain that just came out called SIF Chain. They actually have a 300% APY yield program. So my view is like, why not make that money? It's free money. And so I don't have like emotional attachment to chains. Oh, this is good. I like this. This is my friend. This one's not my friend. I look at it from a very objective point of view. What are the opportunities? What are the challenges that I can evaluate for myself? You know, I've coded with the smart Binance Smart Chain. I've coded on Polkadot. I've coded on Cosmos, Corda, Ethereum. I've coded Bitcoin stuff as well. So I get to see the dirty laundry, if you will. Like there's the entire space is very raw and very not mature yet. So if you go to Binance, you might have some challenges with liquidity, right? Whereas you won't have a liquidity problem on Ethereum. You might have a gas problem on Ethereum. So it's pros and cons. And depending on what you are trying to do, what you're a trader, or you're trying to build an application, or you're trying to raise capital, then you make a determination which chain should be the right chain. But there's no reason why you can't trade, you know, on more than one chain. You can say, well, I've got stuff going on the Ethereum chain, I'm trading there, and then I'm also trading on, you know, the Binance Smart Chain, or on Polkadot, or you know, SIF chain and things like that. You can work on those. As an investor, you're going to be objective and agnostic around what's what. But you'll see, I think, the benefit of the Ethereum chain is the ecosystem is very, very large. Nobody is able to replicate that ecosystem yet. Will these other chains be able to do that? We'll see, you know. But that's the benefit, that if you as a protocol creator, you create a protocol and you want to probably put it on Ethereum because you're going to get the most liquidity, assuming you do the marketing the right way and things like that. But yeah, the transaction rates for all the chains are very poor. You know, 1,000 transactions per second on some of these newer chains is still not enough. Like Ethereum is at 20-30% TP transactions per second, not even 30, not even 25 maybe. And that's nothing compared to what the world needs, right? The global trading community needs. We need tens of thousands trades per second, transactions per second, and that's emerging. There's another blockchain called Algorand. They're based in Boston. I know the team. I've actually been to their office. You know, they're doing some very, very interesting things. They're doing some very, very interesting things with cryptography. One of the founders of that of Algorand is a Turing Award winner, which is one of the highest awards you can get in computer science. And he's one of the inventors of what's called zero knowledge proof cryptography. So lots of innovation happening, and it's still very early stages. What's important is like accumulate the knowledge to find your angle and opportunity to make money, and then you make money, and then maybe the thing that you make money on makes money for you for 6 months, and then it doesn't make money for you, so then you move on to something else.
Yeah, I have a follow-up question because you mentioned liquidity, right? I have multiple questions. So let me ask the first question, because you mentioned the transaction speed. So I wonder whether you have looked into Solana, right? Solana, I think is the fastest blockchain out there, right? It has the proof of history, which makes it super fast. So I want to know what's your take on Solana. This is my first question. So my second question is, you mentioned liquidity. So I just wonder, whether liquidity is very important. Like, of course, like Ethereum blockchain has the highest liquidity, right? But maybe blockchain, maybe like a Binance chain doesn't have that much liquidity. Then I think what depends on, what's the most important thing is where the opportunities are. Like, are the opportunities mostly in this mature, high liquidity blockchain, Ethereum, or it's in the new emerging, right? New blockchains like Binance chain or other chains, right?
Yeah, and so the chain that you mentioned, I've heard of them, but I have not played. Like for me, in order for me to understand the chain, I have to code with it, and build an app on it, play with it, run it, see on my computer, and try to break it, all kinds of stuff. Then I can say I understand something about the chain, and I haven't done that with that, so I can't really comment on it. Like on it, a lot of chains, they advertise all kinds of speeds, right? And those advertisings are not actually always correct. I know some chains that they deliberately misstated their TPS rates, and I know they're misstating it unintentionally. So you have to do your own homework, and you have to study and evaluate for yourself. Now, the TPS rates on like Ethereum, they're going to change because what's coming up is called transaction rollups, which is I can do the off-chain transactions. Let's say you and I trade back and forth 10 times. We can record that 10 trades with one transaction trade on the blockchain. So we can do off-chain transactions and then record those 10 trades with one transaction. And that
that's layer 2. Yeah.
Yeah, the layer 2 stuff. But layer 2 stuff is now becoming the norm. It's becoming layer 1, right? So layer 2 is now becoming layer 1. It's becoming the norm. So lots, like the chains are competing, which is great. This chain is doing this now, that this chain is doing that. And so what's important, and when you say opportunities, which one is liquidity important or not? It depends on what opportunity you're talking about. If you're a trader, you will die without liquidity. If you don't have liquidity, you don't want to trade. You don't want to trade when there's low liquidity. Liquidity is more important than transaction fees, because the transaction fees, if you have large positions, you're not going to care about the transaction fee. All right, I've got to pay $200 for this, but I've got to offload $500,000 position or $1 million position where I just gained $100,000, or I could potentially lose $100,000. You're not going to worry about the gas fees too much. It's high, it's ridiculous, but you might not worry about it. But if you have to offload a very large position and you can't get the liquidity, you're in trouble. You're going to lose more than the transaction fee because you don't have the liquidity. You can't move it. You can't unload that position. And so liquidity is king, right? Or liquidity is queen. Liquidity is the ruler. Liquidity is the most important thing in a market. The transaction fees, I've talked to traders, they don't care about the transaction fee. Like, that's fine, not a problem. I just can't be stuck with a position. So again, it depends on your trading strategy. It depends on what opportunity are you talking about. You're a protocol creator. You're creating a protocol. You're creating a brand new protocol on Binance Chain. Are you creating something that really requires high transaction rates specifically? That you're doing something specific. So then then maybe you're better off using a smart chain or things like that. But it's case by case, right? It's not like one chain is everything now. We're still in the early stages. 5 years from now, Ethereum could be dead. It's possible, right? And so I have that view that anything can change any minute. So, but it depends on the opportunity that you're looking for. If you're looking at it from purely from a trader point of view, tokens in and tokens out, swapping tokens, then liquidity is going to be important for you.
So by traders, do you mean like doing crypto arbitrage? Well, or like other, like just buying low, selling high, that kind of thing? Like, because there are different like trading strategies, right? You can also do market making or something like that. So do all those kind of strategies require high liquidity? Or maybe for crypto arbitrage, maybe it doesn't matter. Like low liquidity probably is better because there might be more opportunities in crypto arbitrage. Yeah.
I would say in general, liquidity is always important. Even if you're doing arbitrage, that's just a strategy, right? Just talking about different strategies. I haven't seen a strategy where, arbitrage occurs because of low liquidity, right? Arbitrage occurs because of low liquidity.
Yeah.
but arbitrage does not thrive in low liquidity. It's two different things. So where there's low liquidity, the spreads are wider. Potentially, there's more chance for arbitrage to exist. But at the end of the day, if you ask an arbitrage trader, do you want liquidity or do you not want liquidity? He's going to want liquidity, right? All traders will want liquidity, but where they find their opportunities is typically in low liquidity situations.
Yeah. Okay. I don't want to take everyone's time, so I'll just pause here to allow other people to ask questions.
Sure.
Now, can I have one more question on the yield farming? So when you talk about yield farming, you're talking about we're aiming at the highest yield. But on the other side, we consider risk there. So, I mean, either counterparty risk.
Yeah, I cannot hear you clearly. Can you repeat that, please?
Yeah, sorry for.
Yeah.
Okay. So I mean, on yield farming, you were talking about we need to search for the highest rate, the highest yield on the market. But when we do the yield farming, how do we know the risk? We're always talking about the Sharpe ratio. We need to understand. Okay, the firm who give us 10% return may not be able to afford that yield to us. Then do we in the currency world, do people also consider that kind of counterparty credit risk there? Because it's also changing every 10 minutes, I would say. Yeah.
Yeah. So with yields and automated market making, there is no counterparty. It's the counterparties are detached. The traders trading with the liquidity pool, and there are people adding and removing from the liquidity pool. There are liquidity providers. They're adding liquidity or removing liquidity. It's two separate functions. They've been divided.
Central clearers, some kind. Yeah.
Yeah. But the risk is there. The risk, there's no counterparty risk. There is smart contract risk. There is risk. There's protocol risk. There's the risk that the protocol doesn't work in some severe edge case, like some situation where if this happens and this happens and this happens, there's going to be a problem. Those are, let's say, call those edge cases. Then that risk exists across all of DeFi. So I worked on a stablecoin project where I built a Monte Carlo harness for the stablecoin to try all kinds of scenarios to see what happens with the stablecoin. How stable is it in different situations? We have like 150 different inputs, and then you run a Monte Carlo on that, and you see what happens. And we find situations that you never thought of, that the stablecoin just flies, goes to like $3, or comes down to 5 cents, and that is something that happens. So then the smart contract developer has to adjust for that. So there is risk, but some of the bigger protocols like Compound, there's less risk because they're used by so many people. Just by the usage, they've matured, and they fix all these tiny bugs over time. They've matured, and so there's less and less risk. But counterparty risk doesn't exist in the same way as it exists in traditional finance. But you do have other kinds of risks that doesn't exist in traditional finance. You have other risks. You don't have protocol risk. When you go shopping on the newspaper, you look in the newspaper, my CD rates, oh, which bank has the best CD rates? I'm going to go to that bank. You're doing yield farming.
Yeah, I just want to make sure when I say I want to get a 10%, that guy's whatever, whoever provided 10%, he really has the capacity or ability to give me that 10%.
Yeah. So you're looking. You want what's the risk adjusted return rate?
Yeah, something like that. Yeah.
Yeah, like the Sharpe ratio, but that's more complex to calculate.
Yeah. Okay, got it. Thank you. Thank you. Bye.
Okay, I think the time's up, and I really appreciate Jamie and all the friends here, 200 people, and then thank you and good night. We're looking forward for next Sunday's finance talk, and also please go online to check out Jamie's class, and we are excited to have him join us. Thank you, Jamie. Good night. Thank you.
Thank you, everyone.
Oh, we have a
WeChat
WeChat
group.
We have a WeChat group. If you have a question, you can ask there, but remember, respect our speaker's time. Is midnight here and then Eastern time, so he would take some time to maybe answer you back. Okay, thank you, everyone.
Thank you.
Thank you. Bye-bye. I'm gonna we have a replay on YouTube. After I click the button, the replay will also